There are many reasons you started your business: freedom, flexibility, and financial independence. But have you ever wondered what that road to financial independence would look like? As a CPA, I often get asked by business owners, why does school teach you about calculus but not the vital skills needed as adults, like taxes, investments, and budgeting? If you are planning to start a business or you're a first-time business owner, today's video will help you understand how to run a profitable business and how to actually make money. After all, we started our businesses with the hope of supporting our dream life and gaining the freedom to live on our own terms. And to make money, you first need to understand at least the fundamentals of having a profitable business. So let's jump right into it. The basics. As a business owner, you're going to be wearing many hats, and one of them is going to be the finance person for your business. To understand how much you're making, you need to track your income and expenses. And we summarize these numbers in what is called an income statement, which is also known as a profit and loss statement. You also want to understand your business's worth, taking into account your assets and liabilities. These can be organized into what we call a balance sheet. An income statement is similar to your personal life's budgeting, such as your earnings minus all living expenses like your mortgage or rent, car payments, groceries, and the list goes on and on. A balance sheet is similar to how you would calculate your net worth, which takes into account assets like your home, your car, your investments, minus any debt that you might have like your mortgage, your car loan, as well as student debt, etc. While you can manage personal budgeting as you like, in the business world, there are certain rules around preparing income statements and balance sheets. And this is because these documents must be easily read by others for purposes like tax reporting, bank loan applications, or investor reporting. So let's go over a quick example of an income statement and balance sheet to really hit it home. This is just a fictitious financial statement. I actually asked ChatGPT to make up the numbers for me. And a side note here is for those who are worried about AI taking over accounting jobs or bookkeeping jobs, rest assured, I'll go into a little bit more detail with the issues that I ran into with ChatGPT, who couldn't even come up with a basic financial statement properly. But I'll just show you that in just a little bit after we go into how to read it first. So let's get started. This is an income statement, a very simple one for an IT consultant. And you can see that their main source of revenue is their IT consulting revenue. With a lot of businesses, this will differ. For some of my clients, they have a lot more different sources of income, even up to 10 different sources of income, depending on what sort of services or products that you offer. In this case, like I said, it's very simple. You'll see that there are very basic expenses that a lot of businesses might have here, like office rent, office supplies, internet and phone, travel and entertainment, marketing and advertising, professional development, insurance, utilities, and professional fees. So these are mostly the basic expenses, but depending on what sort of business you are in, there might be more unique expenses that are suitable for your business. So for example, if you are in the media business and it's your job to look presentable, then maybe your hair and makeup expenses is included here as part of costs to earn business income. So the total expenses here is $33,400. Now, looking at net income is calculated by taking revenue less expenses. So revenue being $98,000 minus total expenses of $33,400 to get to net income of $64,600. Now, keep in mind that this is before tax. This amount will be lower once you pay your taxes and you calculate your after-tax profits. The profit margin here is 66%, which is calculated by taking your net income divided by your revenue of $98,000. So you can see here that profit margin is on the higher end because this is a service-based business, so you might not have much expenses, and essentially you are selling your time and your expertise. And keep in mind that this percentage is even lower once you pay your taxes. So once you pay your taxes, you have a lower net income after tax, and then if you divide that by your total revenue, you'll notice that it will be a lower amount. So the balance sheet is basically the financial position of your company at a particular date. Usually it's at the year end. So most businesses might have a December 31st year end. And in a balance sheet, there are three main components: the assets, the liabilities, and the equity. And the formula here is that assets must equal to liabilities plus equity. And we'll be addressing that in just a little bit. So we'll kind of go over what's included in a balance sheet. The first section here are assets. assets. So what's included in assets is what increases the value of your company. So things like cash, accounts receivable here means that you have provided your services or your products and you have issued an invoice, but you have yet to receive cash for that invoice. So it's sitting here as cash to be. For office equipment, something that we haven't touched upon is depreciation. So here you can see that there is office equipment and is categorized under assets instead of as an expense in the income statement. And the reason being is because an office equipment or any sort of capital asset for that matter has a lasting benefit. And lasting benefit means that it lasts many years. So instead of being able to expense it all 100% in a given year, because it has a lasting value, we can only take a percentage of it as an expense, and this is called a depreciation expense. So for an office equipment here, say that office equipment has a useful life of 3 years, then we simply take the $15,000 divided by 3, and that results in a depreciation expense of $5,000. So I can see here that ChatGPT kind of forgot to include any sort of depreciation expense. That is why capital asset is part of your balance sheet as part of your assets, and then depreciation expense is taken on your income statement. Another asset here is prepaid insurance, so any sort of expenses that you paid ahead of time and that you have yet to benefit it from. Now moving on to liabilities, accounts payable is opposite of accounts receivable. So you have a vendor or a supplier who has already done their part in providing you with their services or their product, and they have issued you an invoice, but you have yet to pay because there is like a 30-day pay period. In that case, because it has yet to be paid by cash, here it sits as accounts payable. Now for unearned revenue, it means that you have received income from your customers, but you have yet to deliver on your services or you have yet to deliver your product. In this case, because you have received cash upfront without delivering on those services or product, it is considered a liability in the meantime. So equity is the section that confuses most business owners, but what's included in equity is owner's capital. So this is your investment into the company. In this case, since an IT consultant doesn't need much to get started on their business, it's mostly an exchange of their time, a little capital is required. But in the case of, selling inventory or merchandises, you might need a bigger capital here to get started in order to purchase things like inventory. Now for retained earnings, you can kind of understand it as accumulated profits over time. And in this case, retained earnings beginning of the year is 0 because the company has just started and this is their first year of business. And what gets added to retained earnings every year is the net income. So you can see that the $64,600 here is agreeing with the $64,600 from the income statement. So this flows here and that results in your total equity. Now, other items that might be included here that are sort of outside the scope of today's video are things like dividend payments. So in order to calculate retained earnings, first you start off with opening retained earnings, which is the previous year's balance. In this case is 0 because it's a new company. You add the net income and then you also subtract any dividend payments that you make, and that calculates to your ending retained earnings. In this case is pretty straightforward since we are assuming there are no dividend payments, so it is just your net income for the year. So you can see here that the net income accumulates and your retained earnings is showing the accumulation of profits over time, which decreases whenever you take out dividends. So that is your equity, and you can see that the total liabilities plus equity, so $12,000 plus $64,610 here, equals to $76,610. And this amount equals to the total assets here. And you can see that I did the check by confirming that the amounts add up to 0 because assets need to equal to liabilities plus equity. Just keep in mind that this is a very simple example. I find that a lot of business owners have trouble with this balance sheet, and oftentimes you will not have 0 and you will have some sort of unreconciled difference, meaning that you have missed some amount somewhere, resulting in the balance sheet not balancing. And usually that's an indicator that you have missed some sort of transactions that went unnoticed, and that is resulting in the difference where assets does not equal to liabilities and equity. So that's just a quick overview of how to read the income statement and the balance sheet for your business. So I just wanted to quickly go over what ChatGPT gave me because I thought it was interesting. So I asked it to create a fictitious financial statement for an IT consultant, and I noticed noticed there were a couple of issues that it was not picking up, which I found to be very basic rules of a financial statement. So for example, the balance sheet, the equity portion needs to reflect the net income of the income statement, and it wasn't doing that. So you can see that here, retained earnings did not seem anywhere close to the net income. So I asked that question. It said, I apologize. It came up with another set of financials. And what do we notice here for the balance sheet? Total assets of $65,500 does not equal to total liabilities and equity, which is a lot greater. I told ChatGPT about that and it apologized. It came up with another set of numbers. In the end, it didn't work. So I did have to go back and fix a couple of things. But for those who are worried about ChatGPT taking away the role of accountants and bookkeepers, it still has a lot of ways to go. So I thought that was interesting. I wanted to quickly cover that. And now let's get back into the rest of the video. Now that you understand the purpose of an income statement and balance sheet, let's talk about profitability. How to calculate profitability. Your business's profitability is reflected in your income statement, which shows your income sources as well as your expenses. It's like calculating your savings in your personal life. The more the savings, the more money you have. Similarly, the higher the profit in a business, the more money you have available then to reinvest back into the business. Allow me to illustrate why it's vital to keep a constant check of your profitability. Let's take two businesses as examples. Picture business A, raking in a handsome $1 million a year in sales, but with a slim profit margin of just 5%, making around $50,000 per year in profit. On the other hand, we have business B, which pulls in a more modest sales of $200,000 per year, but boasts a substantial profit margin of 50%, which is equal to $100,000 per year. Even though business A's revenue towers over that of business B, its high operating costs eat into the profits, leaving it less lean. Conversely, business B may earn less in terms of total revenue, but it's adept at keeping expenses in check, which leads to its higher profitability. Now, this scenario perfectly illustrates why it's not just about the money that you make, it's also about the money that you keep. Many business owners are all about boosting sales, but remember that high sales don't mean much if you're not making enough profits. It's like in your personal life, if you earn a big salary, but you're also spending more and more because of lifestyle inflation, you won't have much left over to save towards financial independence. You would still be living paycheck to paycheck, and at the end of the day, it's profitability, not sales, that really counts. That's what will decide if your business can actually support you. How to increase profitability. To increase profitability, remember the formula that profit is equal to sales minus expenses. Using basic algebra, we know that to increase profit, we would either need to increase sales or decrease expenses. Ways to increase sales would be through marketing to raise awareness of your product or services, increasing your prices by enhancing your value, and so on. In order to decrease expenses, maintain lean business operations. And what this means is that you need to review and categorize your expenses. And what I like to do is while I go through my expenses, I like to label P for those expenses that actually help in generating profit, R for replaceable expenses, and U for unnecessary expenses. And I do this on a monthly basis in order to understand what costs are not serving the business and cutting out unnecessary subscriptions. For replaceable expenses, I look for better alternatives at a friendlier price point or come up with creative ways to replace it altogether. For example, I like to negotiate phone bills and internet bills with the retention department at least once a year. And one of the creative ways I found in replacing one of my expenses was that instead of having a virtual assistant to edit and proofread my emails and scripts, I like to use AI software like ChatGPT to do it for me, which is way faster and also a fraction of the cost. What to do with profits. Once you've accumulated all the profits, there are a couple of ways you could use that money. You could pay yourself a bonus and treat yourself to a nice vacation or a nice meal out. You could also reinvest back into the business to help it grow and scale, or you could also buy investments like real estate and stocks to further build your wealth. Diversifying your investments is crucial in order to really build your wealth, and the top 3 wealth generators are your business, real estate, and stocks. I mean, think of any successful person that you look up to, and I'm betting that they often have a combination of these 3 wealth generators if not all three. Don't forget about taxes. We haven't discussed the one big factor that affects all businesses and that ultimately impacts profitability, and that is taxes. After-tax profits are what remain for you after subtracting taxes from your profits. And taxes can be one of your top expenses and can definitely eat away at your profits if you aren't proactive and don't plan for it. To increase profits, it's very important to plan ahead to minimize taxes before tax season arrives and not do it last minute. If you are planning to start a business or you are a first-time business owner, investing in your skills as an entrepreneur is invaluable. If business finances feel like a maze to you and you are seeking a guiding hand to ensure that you are on the right path, I've designed the Path to Profits program just for you. It's all about empowering new business owners to navigate financial complexities with confidence. For more information, check out my link in the description box down below. Thank you so much for watching today until the very end, and I'll see you in my next video. Bye!